Broadly speaking, in August we had three areas of political tension. Firstly, and most loudly, we've had North Korea and the ongoing geopolitical challenges that we see there. Secondly, we had Charlottesville and the Trump administration's response to it. And lastly, we've seen Hurricane Harvey and some of the significant challenges that the state of Texas is facing. So the question there is, what impact has all this had on volatility? And what we see in August is that the VIX index, a measure of US equity volatility, has spiked a couple of times, but even if we look at the totality, the average has gone up a little bit over the month of August, but is still well below long-term averages. It's a challenge for financial markets in some respects, because you could argue that they don't do a particularly good job of pricing in low probability, high impact events, particularly geopolitical ones. At the moment, you could look at markets and say that their conclusion is that everything will be okay, that the global economy will continue, and we'll wait to see whether that proves to be correct. So August proved to be a relatively busy month for Brexit negotiators. If you believe the European Union negotiators, there's been relatively little progress. If you listen to the UK negotiators, you see supposedly a little bit more progress. What's clear is that there is an awful lot to do between now and 2019. So when we think about the implications for portfolios, there are a couple of relevant points. Firstly, we saw some of that uncertainty reflected in weaker sterling in August. But as we begin to see how the Labour Party is positioning itself and the challenges that the UK faces to extricate itself from the EU cleanly and neatly, it seems clear that we have to consider the possibility that we may get a more watered down version of Brexit. And the question for us from a portfolio context is, what does this mean for our positioning? When we look at our portfolios today, what we have is a lot of globally diversified equity exposure. And broadly speaking, we benefit to some extent when sterling weakens in that context. Now, there's the possibility we need to consider that a milder Brexit, whatever that means, will translate into possibly a stronger sterling, and we need to think about how to position portfolios in that context. Over the last few months, we've been expecting to see signs of central banks beginning to find ways to remove some of the quantitative easing that they put in place after the financial crisis. And what we've seen overall is that even though economic growth has been relatively good and unemployment has steadily fallen across a range of economies, actually we haven't really seen yet a meaningful pickup in inflation. And central banks have had a little bit more headroom than maybe we expected to keep interest rates relatively lower for longer. So when we think about what that means in practical terms, the Federal Reserve in the US was maybe expecting to have another interest rate hike towards the end of the year. Now, the expectation is that we may not see that. In the UK, the challenge is slightly different. Thanks to a weak sterling, inflation is already above the 2% target, even though economic growth is beginning to slow. And the Monetary Policy Committee is facing this delicate balancing act between slow growth, relatively higher inflation, and the extent to which they want to raise interest rates into that environment. The fact that, broadly speaking, inflation, even in the UK, is coming down, maybe gives the central bank a little bit more headroom to wait and see on monetary policy, rather than feel the need to raise interest rates immediately.